Picture this. It's the last Friday of the month, and like clockwork, your bank account lights up with dividend payments without you lifting a finger. No stock picking stress, no market timing guesswork. Just steady, reliable income. If you're too busy to micromanage investments but still want to build wealth, today's your lucky day. I'll show you 3 proven approaches to earn monthly dividends, including high-yield ETFs, monthly paying stocks, and a surprise twist with household name blue-chip giants, even if they only pay quarterly. Let's turn your portfolio into a cash-generating machine. Welcome to the Trade Savvy Academy. Why monthly dividends matter? Monthly dividends act like a paycheck from your investments. They're predictable, align with bills, and let you reinvest faster, thanks to compounding. This is the ultimate set-it-and-forget-it strategy for busy people. There are 2 main approaches to invest in monthly dividends. Number 1, individual dividend stocks. These are shares of companies that pay dividends monthly. They tend to be more stable, established companies with a history of consistent payouts. Number 2, dividend ETFs, also known as exchange-traded funds. These are funds that hold a basket of dividend-paying stocks or use strategies like covered calls to generate income. ETFs offer diversification, which reduces risk, and many pay dividends monthly. Let's dive into both approaches, including specific examples and strategies. Approach 1. Individual dividend stocks. If you prefer to invest directly in companies, several blue-chip stocks pay monthly dividends. These companies are typically well-established, financially stable, and have a long history of rewarding shareholders. Here are a few examples. 1. Realty Income Corporation. It's part of the real estate sector, which are known as real estate investment trusts. It offers a dividend yield of 5.5%. Why invest in Realty Income Corporation? Realty Income is known as the monthly dividend company and has paid over 600 consecutive monthly dividends. It invests in commercial properties and leases them to high-quality tenants, ensuring steady cash flow. Second, Main Street Capital. It belongs to the financial sector and is a business development company. It offers a dividend yield of 7%. Why invest in Main Street Capital? Main Street Capital provides capital to small and mid-sized businesses and generates income through interest and dividends. It has a strong track record of monthly payouts and consistent growth. Third, Stag Industrial. Stag belongs to the real estate sector. It offers a dividend yield of 4%. Why invest in Stag Industrial? Stag focuses on industrial properties which are in high demand due to the growth of e-commerce. Its monthly dividends are supported by long-term leases with reliable tenants. Fourth, AGNC Investment Corp. Also belonging to the real estate sector, focusing more on mortgages. It offers a dividend yield of 14%. Why invest in AGNC Investment Corp? AGNC invests in mortgage-backed securities and generates high yields. Keep in mind, high-yield names can be more volatile, so they're better suited for risk-tolerant investors. Let's move on to approach 2, dividend ETFs. For those who want diversification and simplicity, dividend ETFs are an excellent choice. They allow you to invest in a basket of dividend-paying stocks or use advanced strategies like covered calls to generate income. Here are some top monthly paying ETFs. 1. Global X Nasdaq 100 Covered Call ETF, ticker symbol known as QYLD. It offers an estimated dividend yield of 12%. Strategy: QYLD holds the Nasdaq 100 index and sells covered calls on its holdings to generate income. What are covered calls? Covered calls involve selling the right to buy a stock at a specific price, which provides premium income in exchange for limiting upside potential. Why invest in QYLD? It is ideal for income-focused investors who want high yields and are comfortable with moderate growth. Second, Global X S&P 500 Covered Call ETF, ticker symbol known as XYLD. It offers an estimated dividend yield of 10.5%. Strategy: similar to QYLD, XYLD holds the S&P 500 index and sells covered calls. It offers slightly lower volatility than QYLD due to the broader market exposure. Why invest in XYLD? XYLD is a great option for those who want exposure to the S&P 500 with enhanced income. Third, JP Morgan Equity Premium Income ETF. It offers an estimated dividend yield of 8%. Strategy: The JP Morgan ETF uses a combination of equity investments and covered calls to generate income. It focuses on low volatility stocks, making it a more conservative option. Why invest in JP Morgan Equity Premium Income ETF? This ETF is perfect for investors seeking steady income with lower risk. Fourth, iShares MSCI Brazil ETF. It offers an estimated dividend yield of 6.5%. Strategy: EWZ invests in Brazilian equities and uses covered calls to enhance income. It's a more niche option for those looking to diversify internationally. Why invest in EWZ? EWZ offers exposure to emerging markets with the added benefit of monthly income. Fifth, ProShares K1 Free Crude Oil Strategy ETF. It offers an estimated dividend yield of 5%. Strategy: this ETF tracks the price of crude oil and uses a covered call strategy to generate income. It's ideal for investors who want exposure to the energy sector. Why invest in OILK? OILK provides a way to profit from oil price movements while earning monthly dividends. Now you must be wondering, what exactly are covered call ETFs? Covered call ETFs are a type of income-focused investment that combines stock ownership with options trading. Here's how they work. 1. Stock ownership. The ETF holds a portfolio of stocks, such as the NASDAQ 100 or S&P 500. 2. Selling calls. The ETF sells call options on the stocks it owns. A call option gives the buyer the right to purchase the stock at a specific price, the strike price, within a certain time frame. 3. Income generation. The ETF earns premium income from selling these options, which is distributed to investors as dividends. Pros of covered call ETFs: high dividend yields, often 8% or more. Lower volatility compared to pure stock investments. Passive income with minimal effort. Cons of covered call ETFs: limited upside potential, since the ETF gives up some gains if the stock price rises above the strike price. Can underperform in strongly bullish markets. Let's move on to approach 3. Blue chip dividend stocks. Quarterly payers, staggered for monthly income. Oh wait! Blue chips only pay quarterly? True, but by selecting companies with different payout schedules, you can create a de facto monthly income stream. Here's how it works. You invest in 3 to 4 blue chip stocks that pay dividends in different months. Example: Coca-Cola pays dividends in April, July, October, and January. Johnson & Johnson pays dividends in March, June, September, and December. This creates a staggered dividend calendar that pays you every month. Some of the top blue chip picks. Johnson & Johnson. It offers an estimated dividend yield of 3.1%. Johnson & Johnson pays out in the following months: March, June, September, and December. Why invest in Johnson & Johnson? J&J is a dividend king with 60+ years of payout growth. Second, Procter & Gamble. It offers an estimated dividend yield of 2.4%. Procter & Gamble pays out in the following months: January, April, July, and October. Why invest in PG? PG sells essentials, such Tide and Gillette, even in recessions. No matter how bad the economy, you still have to wash your clothes. Third, Coca-Cola. It offers an estimated dividend yield of 3%. It pays out dividends in the following months: April, July, October, and January. Why invest in Coca-Cola? 60+ years of dividend hikes and its global brand dominance. Warren Buffett's Berkshire Hathaway owns 9.3% of Coca-Cola, earning him $776 million yearly dividends in 2024 alone. Fourth, PepsiCo. It offers an estimated dividend yield of 2.9%. Payout months are March, June, September, and December. Why invest in Pepsi? Pepsi sells snacks and beverages, and these are known as recession-proof cash flow. Fifth, AbbVie. It offers an estimated dividend yield of 3.7%. Payout months are February, May, August, and November. Why invest in AbbVie? It's a high-yield stock, plus has a strong drug pipeline with names such as Humira and Skyrizi. Here's an example of how I would personally combine all 3 approaches. 1. My core portfolio would be known as safety. Allocate 50% to blue chip stocks: Johnson & Johnson, Procter & Gamble, and Coca-Cola. 2. My high-income portfolio would be known as Covered Call ETFs, 30% allocated to XYLD, JP Morgan ETF, or QYLD. 3. My monthly payers would be known as Boost Cash Flow, 20% allocated to Reality Income, Main Street Capital, or AGNC Investment Corp. Let's do some math now. Based on the above allocation of funds, let's look at an example portfolio of a $10,000 investment. $5,000 in blue chip names. For example, $1,500 in Johnson & Johnson, $1,500 in Procter & Gamble, $1,000 into Coca-Cola, and $1,000 into AbbVie, $3,000 in Covered Call ETFs, $1,500 into XYLD, and $1,500 into JP Morgan ETF. And lastly, $2,000 in monthly payers. $1,000 allocated to Realty Income Corporation and $1,000 allocated to Main Street Capital. Based on all the names we discussed today, let's say an estimated yearly return on investment would generate 7 to 10% or about $70 to $80 in monthly returns. Here are some critical tips for success. 1. Automate reinvestment. Use DRIPs, Dividend Reinvestment Plans, to grow shares passively. We will shortly go over the DRIP strategy. 2. Diversify sectors. Avoid overloading on real estate or energy. Balance with healthcare like Johnson & Johnson, or tech like XYLD, and or consumer goods like Coca-Cola. 3. Watch your fees. ETFs like QYLD charge 0.6% annually. Reasonable for the yield, but don't ignore costs. Let's go over the DRIPs strategy. Dividend Reinvestment Plan is the secret sauce of wealth building. Instead of taking dividends as cash, Dividend Reinvestment Plans automatically uses them to buy more shares of the stock or ETF that paid them. Over time, this creates a compounding snowball. More shares equal more dividends, which equal even more shares. It's like planting a money tree that grows itself bigger every month. We will continue using $10,000 as an example, and how DRIP's strategy turns $10,000 into a cash machine. Let's use the example portfolio from earlier. Our initial investment of $10,000. Allocation, 50% into blue chip stocks, 30% into covered call ETFs, and 20% into monthly payers. The average yield of 8.5% annually, which equals $850 yearly, or roughly $70 monthly. Key assumptions. Dividends are reinvested monthly using the DRIPs strategy. Portfolio grows at 8.5% annually, combining yield plus modest price appreciation. No additional contributions, just reinvesting dividends. 5-year projection. The snowball starts rolling. Portfolio value would be $15,220. Monthly dividends of $108, up from $70 initially. Total dividends earned $5,220. What happened? Your $10,000 grew by 52% without you adding a single dollar. The DRIP strategy bought extra diversified shares in your portfolios over 5 years, accelerating your income. 10-year projection, compounding kicks in. Portfolio value after 10 years would be roughly $23,370. Monthly dividends would grow to $166. Total dividends earned would be $16,370. What happened? Your monthly income more than doubled. The portfolio grows faster now because dividends are reinvested into a larger base. At this rate, you're earning nearly $2,000 per year in dividends, enough to cover a month's groceries or a vacation. 20-year projection. The money tree matures. Portfolio value estimated is $54,720. Monthly dividends grow to $388 per month. Total dividends earned would be $44,720. So, what happened here? $10,000 turned into nearly $55,000, and you're earning over $4,600 a year in dividends. Even if you stop reinvesting and take the cash, that's $388 per month. Enough to cover car payment, utility bills, or dinners out. Let's go over the power of starting early, a real-world example. Imagine 2 investors, Alex and Sam. Alex starts at the age 35 with $10,000. Alex uses the DRIP strategy for 30 years And Sam starts at age 50 with $10,000 and also uses the drip strategy but for 15 years. Let's take a look at the results when both Alex and Sam are 65 years of age. Alex's portfolio would be worth $127,000 and generate a monthly income of $900, while Sam's portfolio would be worth $35,000 and generate a monthly income of $247. The lesson learned in this scenario is time is your greatest ally. Starting just 15 years earlier gave Alex 4 times more income than Sam. Let's take a quick look at how to maximize drip strategy power. 1. Pick reliable pairs. Stick to blue chips like J&J or ETFs like XYLD. Avoid dividend cutters. 2. Stay consistent. Even small amounts matter over time. 3. Ignore market noise. Drip strategy works best when you let it run for decades. Don't panic sell during downturns. Cheaper shares mean higher future dividends. And some final motivation for you. Your grandparents' savings account earned 1% interest. Your drip portfolio can earn 8% or more. That's the difference between retiring on canned soup and retiring on steak. The math doesn't lie. Reinvested dividends can turn a single $10,000 investment into 6 figures if you let time do the work. Imagine the same starting with $50,000 or $100,000. Smash that reinvest button, set it and forget it, and watch your wealth snowball. Then tap subscribe while you're at it to unlock more stock market strategies straight to your feed. Your future self and portfolio will thank you.